Well, hey, everybody. It is 2026, and we're here to talk about the Southern California real estate market, probably one of my personal favorite topics to talk about. And this year is not going to be like other years. This is not going to be the same thing that we saw in 2025. And there's a few reasons for this, right? So, probably the biggest reason for this is that we are entering a midterm election year. And in fact, I don't care whether you are a Democrat, whether you're a Republican, whether you're uh, Green Party or Spaghetti Monster church candidate or believer or whatever. The fact is, whenever you have any president, I don't care who it is, especially in that midterm election, they're going to want that year to look as good as possible. And there's really a lot of things about affordability that have heard. I think a lot of Americans are really feeling the pinch on real estate, right? You've heard, and whether these are necessarily entirely real perceptions or whether they are just perceptions, it doesn't really matter, right? Because you've got people who are in office who would like this year to look better than it is. So I think there's going to be a lot of pressure for an improving housing market and for a more active housing market. And we're already starting to see that, right? We saw a statement last week from President Trump that Fannie and Freddie would be buying $200 billion of mortgage backed securities. This is much more important than the Federal Reserve. This will have a much greater effect on interest rates. So that's reason number one that this year is not going to be like last year. We're already starting to see some of these, we'll call them political forces, right, at work on our housing market. Another reason is we've got really a lot of buyers and sellers who I think, frankly, we've got some pent up demand to make housing changes. Kids being born, people retiring, all these kinds of things. And I think people have been in this mode of waiting for the right moment. And I'm hearing it all over town that we are just seeing people are tired of waiting. And they're seeing a little bit of break of interest rates. And I think that's really proving to be a big motivating factor. I think this is the year where we're going to see kind of our housing market come back alive. And I'm already seeing signs of it, right? We're hearing stories about open houses with 40 people coming through. We're seeing some prices on some things that are a little bit surprising for January prices. We're seeing people get the kind of money that normally we wouldn't see that level of activity in January and December. So I think this is going to be a big year for people. If you were a buyer on the fence, I'd say really you should have bought a month or two ago. Or, I mean, realistically, October was a great month. We told everybody that. But it's still not too late, right? Because I think we haven't entered that spring up. So let's go ahead. We're going to jump into those stats, and we are going to talk about kind of what we can actually see in here. So if we're going back here, let's take a look at our active listings. Are we up a little bit from last year, especially under a million? Yes, but not really. We see those going up at a normal rate. This is looking a little bit like last year, but I'm telling you, these similarities are going to be short-lived. I have really just a lot of strong indicators. 14 days of new listings. Is this entirely surprising? That, of course, everybody who did not list at the end of last year waited until the first couple of weeks of January to list. Yes, that has absolutely happened, but you'll notice that rate of listings is actually in both categories slightly less than last year. Pay attention to these small changes. They're going to have a big effect later on. If we look at our new escrows, right, those are basically at the same level last year, a little bit less under a million and a little bit more under 1 to 2 million. I think we're going to start to see that change here in the next couple of weeks. Remember, the first couple of weeks of the year are always a little funny because we've got a bunch of inventory coming in, but we haven't really had the buyers have a chance to see that inventory, write offers, go under contract, etc. Absorption rate, that is in the toilet. But if you look again last year, this is kind of more of an artifact of what time of year it is. We have just a huge sort of lagging effect, like a caterpillar, right, or a millipede, where the front end has moved forward, the back end hasn't caught up, and the back end is buyers writing offers. Close prices, again, not a huge sample size here, but I think we're going to start to see really the effects of middle December onward. And that really is, I mean, I've never really had a December that sort of felt that active as it did this year. I think we're going to really start to see some things happening. Percent active after still 14 days on the market. Again, this one is going to be loaded a little bit because of all the new listings that come on the market in the last 2 weeks, but I promise you this number is going to start dropping. Close to list ratio. Again, this is indicating, gosh darn it, a pretty healthy market here, right? And that 98 and change, 99%. of list price. What does that mean? It means we've actually got a market that's in balance. Expect to see a little bit of a spring bump. I can feel it happening already. And that means that basically buyers will get ahead of where sellers are. And we might see this cross again back to that 100% line. If we look at our days on market for new contracts, I think what's interesting here might actually be the shape of this. That 1 to 2 million has already flattened out. It never really jumped to quite the level as it did last year. Our under 1 million, that number is up. But again, I'm telling you, that market, that under 1 million market is way more reactive. And you're going to see that market swing quite a bit more. And I think it's going to swing downward. Now, if we look at our affordability, why do we see that blue line creeping up? It's not because of interest rates. That blue line is because of those closed prices. I still think when you look at this chart and you look at this differential between our rent index and a payment index, when these numbers get closer together like this, that's really a sign that you've got room in your market for pricing growth. I think that is what we are going to see happening. Pricing growth. I expect to see that start to happen. Gosh, it'll probably really start to show up in those stats. I know we've got technically pricing growth this month. And this, I think that's a little bit of an artifact of the time of year, but I think we're going to start to see some real price growth in the next 30 days. And of course, we look at our prevailing mortgage rates, we are just hissing 6%. I think we are going to get to a point where we're really going to cross that threshold. We're already seeing some of the jumbo lenders are in the low fives, almost near that 5% mark for a 7-1 arm. I mean, gosh, I can't really think of a scenario where that wouldn't be a good option to at least explore for somebody. I know conventional wisdom says take the 30-year fixed all day long. That's true until you start to get a huge disparity, like a percentage point or more between those. It starts being like something that you want to look at. Anyhow, thank you so much for watching. Obviously, we're here to just give you advice, help you make better real estate decisions here in Southern California. Read the tea leaves, see what's going to happen this year. We will see you again real soon.